Bitcoin is currently trading around its all-time high of $108,000 and still holding strong key support levels, maintaining a generally constructive market structure. In this video, I'm going to break down exactly what this correction means for Bitcoin's future trajectory. We'll dive into Zscore analysis to show how cyclical highs align with key metrics and what it tells us about the market's health right now. I'll also explore the potential risks ahead, especially with short-term holders facing unrealized losses and the market's current stress levels. Stick around as we uncover why this market phase could lead to a period of stability and growth for Bitcoin. First up, let's talk about the realized price. This metric represents the average price at which all Bitcoins last moved on-chain, essentially giving us the market's aggregate cost basis. Now, there's another important metric called the MVRV ratio, which compares the spot price to the realized price. This helps us gauge the level of unrealized profit or loss that Bitcoin holders are sitting on. When the MVRV ratio is above 1, it indicates that, on average, Bitcoin holders have unrealized profits. Below 1, we're talking about unrealized losses. Right now, the MVRV ratio is sitting at 1.32, meaning on average, each Bitcoin is holding an unrealized profit of 32%. This structure is pretty similar to what we saw after the all-time high in April 2024. It shows that even with the recent correction, there's still an undertone of positive sentiment in the market. Now here's where things get interesting. Over the years, as Bitcoin has matured, the market has become less volatile and the speculative extremes have dampened. This is reflected in a cyclical decay of MVRV peaks near market tops. Each cycle has seen lower MVRV highs. For example, back in 2011, the peak was 8.7x. By 2018, it was 4.81x. And so far, in 2024, the peak has been 2.78x. This trend of diminishing peaks reflects a market that's growing in size, scale, and efficiency. While Bitcoin is still very much a cyclical asset, the extreme highs and lows are becoming less exaggerated. But how do we account for this gradual decline in MVRV peaks? One way is by using a statistical approach called the Z-score. For those unfamiliar, the Z-score measures how far a value is from the mean in terms of standard deviations. It's a handy way to normalize metrics like MVRV and better understand their oscillations over time. Now here's the challenge. If we calculate the Z-score using the entire historical dataset, the results can be skewed by those earlier cycles with much higher peaks. To address this, we've optimized the rolling window used in the calculation, shortening it to focus on more recent market history. Let's look at the results. When we compare the cumulative Z-score with a 4-year rolling window, we see similar patterns, but the diminishing peaks issue isn't fully resolved. Moving to a 2-year rolling window gives us better alignment with recent market dynamics. For example, the peak observed in the most recent all-time high in March 2024 lines up with the peak ranges of the last 2 cycles. Finally, we applied a 1-year rolling window, and this gave us the most refined and responsive results. This approach helps identify both mid-cycle and late-cycle peaks more effectively. During bull markets, prices tend to trade between the 1-year mean and a peak of about 2 standard deviations above it. In bear markets, prices often fall below the mean, with significant lows occurring around 1.5 standard deviations. So where are we now? Bitcoin is currently trading at 105,000, which is above the 1-year mean of 91,000, but below the +2 sigma threshold at 112,000. This suggests that we're still in a bullish phase, though the market has cooled off from recent euphoric levels, which briefly pushed prices above the upper band. The 1-year MVRV Z-score model shows that the market is cooling off after a powerful rally. But what about investor profitability? By analyzing the entity-adjusted cost basis distribution, we can see that all the unrealized losses are concentrated among short-term holders, those who bought Bitcoin near the market peak. The average cost basis for short-term holders is $88,400. The spot price is trading 21% above this level, meaning we're still within the norms of a typical bull market. However, if the market dips below this cost basis, we could see increased selling pressure as short term holders panic. Let's put this into historical context. Over the past decade, during bull markets, the number of coins held in loss typically stayed below 4 million. In early bear markets, that number ranged between 4 and 8 million. Right now, we're seeing 2 to 3.5 million coins in loss. While that's significant, it's far less than the 4 million coins in loss during the corrective phase between July and September 2024. Finally, let's look at the relative unrealized loss metric. This measures unrealized losses relative to the market cap. In previous cycles, external shocks like the COVID-19 pandemic pushed this metric above 10%, but in Q3 2024, it only hit 4.33%. This suggests the current market is experiencing less acute stress thanks to reduced volatility and new demand from ETFs and institutional investors. To wrap things up, Bitcoin is currently trading at its all-time high of 108,000, holding above key support levels and maintaining a strong market structure. This shows that despite the typical fluctuations, the overall health of the market is still intact. When we look at Z-score analysis, it reveals that cyclical highs tend to line up with metrics between 1.5 to 2.0 standard deviations above the mean. This provides us with a useful framework for navigating bullish phases and helps us gauge when the market may be getting overheated, giving us an edge in understanding the broader trends. Lastly, although short-term holders are holding some unrealized losses, with 2 to 3.5 million BTC underwater, the market is showing less stress compared to previous cycles. This points to a more stable, spot-driven environment with less volatility and more investor confidence. And that's all for today's analysis. Thanks for tuning in, and I'll see you in the next one.